All right, today we're going to talk about the accounting cycle. Okay, let's take a look at the definition of accounting. This is the one I like to use. You'll find a different one in the textbook. I think of it this way. Accounting is a process. It consists of a set of steps. And I've got 4 big steps listed here. The first step is to analyze transactions. If you're in the accounting profession, you look at perhaps a purchase of equipment or the payment of a bill, and you have to analyze that transaction based on its effect on accounts. So at this point, you don't really know what a transaction might be, but let's just sketch one out here. Let's say that you purchase a truck. Maybe you are a house painter, and you buy a truck for your business. Well, the way we would analyze that is to look at what you're getting and what you're giving up. And in this case, let's say you purchase a truck for cash. Very elementary transaction. And believe it or not, we're going to have an account called trucks and another account called cash. And the thing that we would say is that my trucks went up, my cash went down. And that would be the analysis for that transaction. You know, there's only 15 or 20 transactions that you really have to know in beginning accounting, and one of them is the purchase of an asset. Now, after you buy this truck, you have to record that transaction, and there's a specific place we record it. It's in a journal. A journal is, well, you could think of it as a book. That's the way your textbook will present it. And the thing you have to remember about the journal is it's organized by date. So the journal is in date order. There's kind of a big fancy word you could use for that. The word is chronological. So if it's in chronological order, it's in date order. And the journal is in date order. But there's something kind of interesting that happens. After you've recorded it in the journal, you then post each transaction. And a good synonym for posting is copying. You're copying the transaction from the journal to the ledger. A ledger is a group of accounts. And the posting process takes all transactions, let's say, that affect cash, and so you have a cash account, and you keep track of the increases and decreases of that account. Using the transaction we talked about earlier, if you buy a truck, you'll have a trucks account, and you'll have to show that your trucks went up. So throughout history, a strange thing about accounting is that steps 2 and 3 are dealing with the same transactions, but we'd like to have them in 2 different orders. The journal is in date order, and the ledger is in account order. So we actually have a book of accounts, and they are in a specific order. And so if the boss says, well, gee, how much cash do we have? You go to the cash account in the ledger, and you can determine the amount of cash you have. All right, the punchline to the story here is that at the end of the accounting period, we have to publish 4 financial statements, and I've got them listed here. The income statement shows the profit that you made, and we don't call it profit, we call it the net income. Net income is equal to the revenues minus the expenses. What is revenue? Well, if you sell a product or a service, a revenue is what you get, or what you earn, let's say, from providing your service. So a dentist provides service to a client, maybe fixes a tooth, and earns revenue. A school earns revenue by charging tuition. You also have expenses. The expenses represent costs that you incur in order to earn revenue. So a couple of expenses, rent expense. You want a nice office to entertain your clients. You have to pay rent on the office. That's an expense. Advertising is something that increases your revenue. It is also an expense. Salary is expense. So if you have an employee, you'll be incurring salaries expense. All right. Second statement is called the owner's equity statement. We'll leave that till a little later. Third statement is actually the place where we start, and we have an equation. The balance sheet shows your financial position, and the formula for the balance sheet goes like this. Assets equals liabilities plus the owner's equity. This formula must always be true. The assets would be things like your cash or your truck. They are things you own, and you use them to generate revenue. Liabilities, a good synonym for liability, is a debt. And the owner's equity represents the amount the owner owns of the business. And the way we express that is by saying it's the owner's claim in the business. If we made a short list of assets here, let's just do that. Cash, accounts receivable. These are amounts that are owed to the owner. Inventory, supplies, and prepaid insurance. All right. One other thing, when you get to the end of the accounting cycle, when you get to the financial statements, then the cycle repeats itself. So let's say that you have a time period of 1 month. On January 1, you start recording the transactions, and on January 31, you publish your income statement, owner's equity, and balance sheet, and a cash flow statement. And then you begin the accounting cycle all over again in February. So this is why we call it a cycle. It rolls from month to month. All right, that's enough for today. Thanks for watching.